Hello everyone, this is Redwan Khalil, lecturer in Liabilities trainer. In our previous video, we have tried to discuss about one of the crucial assets of companies' inventories. Today, we will proceed our discussion on current liabilities provisions and contingencies, which is the second chapter of financial accounting too. We will begin our discussion by defining what a liability is, because the main focus of this chapter or this standard IS 37 is about liabilities. Liabilities include provisions, contingencies, as well as current liabilities. So, what do you mean by liability? Liabilities are obligations of the company arising because of the past events, and which requires a future sacrification of economic benefits. They may require cash, service, products, or other types of resources in order to settle the obligation. In short, liability is an obligation of the company that should be settled either by the delivery of service, by the payment of cash, or by providing or by delivering products for the customers or other parties in the contract. According to the IFRS definition, there are three essential characteristics of liability. The first one is it is a present obligation. It is a present obligation arise from the past event, and it results in an outflow of resources. What do you mean by past event? What do you mean by past event? Past event is an event or a transaction that creates the obligation on the company. For instance, if the company agreed to borrow 2 million after 4 months from now, the company is not liable, or there is no any obligation on the company until that date, or the date that the company borrows the actual money from the lender is reached. So which is the past event? The past event is the event that creates the obligation, or the event that makes the company liable, liable on the payment of the cash borrowed from the creditor. So liabilities, all types of liabilities, or in order to say the company has a liability or the company is obligated, the event that creates the liability should be historical or past. Sometimes the company may expect to receive cash from the customers in the future as an advance payment for the delivery of service or product. At this time, the liability, the future expected cash collection is not considered as a liability, because there is no any present obligation arises at that time. And the last one, liabilities result in an outflow, which is the complete reverse of assets. As we have discussed in our previous video, assets generate a future inflow of cash or other type of resources for the company. Assets have future benefits, but in the contrary, liabilities require a future outflow. Most of the time, liabilities may require an outflow of cash, or in the form of cash when it's paid for the employees, for the government in the form of tax, etc. But sometimes they may paid by the delivery of goods or products and services. Those type of liabilities are arised when the company received cash in advance from the customers before the service or the product is delivered for the counterpart in the contract or for the customers. Liabilities are classified mainly into two parts: current liability and non-current liability, or current and long-term liabilities. The focus of this chapter is current liabilities. What do you mean by current liability? Any liability is considered as a current uh, if if the company expects to settle the liability within 1 year after the end of the accounting period in which the liabilities arise, as clearly stated in the international accounting standards 37. Current liabilities are obligations whose liquidation in a sense whose settlement includes cash, products, or service, is reasonably expected to require use of existing resources, properly classified as current asset, or the creation of other current liability, which means besides the accounting period, the time period between the accounting the end of the accounting year and the settlement dates. In order to consider any liability as a current, it should be settled by using the current assets of the company, which means in order to sometimes the company may agree to settle the liability within 6 months of period, but if the company expects to settle those liabilities by creating another long-term liability, it is not considered, the first liability is not considered as a current, because it is settled by using, it is not settled by using current asset or by creating another current liability. Okay. Current liability is reported if one of the two conditions existed. Liability is expected to be settled within its normal operating cycle, or the liability is expected to be settled within 12 months. Within 12 months means it's not counted starting from the date that the company borrowed the cash, rather it is after the end of the reporting dates. For example, if the company borrowed cash today, let's assume today is sunny 1st 2010, and the end of the accounting period is sunny 30 2010, and the company expects to settle the liability in the next year 2011, but sunny 28. If you count the time gap between the date that the company borrowed the cash, sunny 1st, and the company expects to settle the liability sunny 28, there is a time period greater than 1 year or greater than 12 months of period. So, but if you count the dates starting from the end of the accounting period in which the company borrowed the cash, which is 2030, the time period is lower than 1 year, which means the liability is considered as a current. The liability is considered as a current because of the time period between the two. The two, in a sense, the accounting period, the reporting dates. Which reporting date? The reporting date that the company borrowed the cash or received the service or the product from other parties, and the settlement dates. Okay. Types of current liabilities. Current liabilities include accounts payables. Accounts payables are types of liabilities usually settled by the payment of cash, and they are raised by the purchase of products and services from the customers on a credit basis. Accounts payables are usually their maturity period is not greater than 90 days, and they are not well documented, or there is no any specific documented agreement, written agreement between the two parties. Usually accounts payables are raised by the purchase of product and service. Notes payables, as the name indicates, there is a note or promissory notes between the two parties, the creditor and the borrower. And notes payables may arise from either by the purchase of product, by the purchase of service, or by borrowing a fiat money cash. And their time period, their maturity period may be less than 1 year or greater than 1 year. Notes payables are considered as a current liability if the maturity period is lower than 1 year. Maturity period, in a sense, the time period between, as we have discussed in the previous slides, the time period between the end of the accounting period and the settlement dates. Okay, the other feature for notes payable is notes payables are usually interest bearing or non-interest bearing. If there is a clearly stated, explicitly stated interest on the note, it is called an interest bearing note. But if there is no any clearly stated, explicitly stated interest rate, it is called non-interest bearing notes. Okay. The other current liability is current maturity of long-term debt. Long-term debt means sometimes companies may borrow cash from other parties by agreeing to pay the by in order to pay the liability on installment basis. For instance, let's assume ABC company borrowed 400,000 from XYZ company and agreed to pay the first 100,000 at the end of the first year. Let's assume it is 2011, and the other 100,000 on the second year, the other 100,000 at the end of the third year, and the other 100,000 at the end of the fourth year. Which means the total liability of the company, including the interest, is 400,000 ETB. And but this 400,000 is not paid in a single lump sum amount for the creditor, and at this time it becomes a little bit difficult to classify the liability as a current or non-current. So according to the IFRS classification rule, this 100,000 or the 100,000 that is expected to be settled within 12 months of period after the after the end of the accounting period is considered as a current liability. This 100,000 is called the current maturity of the long-term debt. This 400,000 in total is a long-term debt for the company. It is not fully settled within 1 year, but the portion of it is paid within 12 months after the end of the accounting period. So this amount is called current maturity of long-term debt or current portion of long-term liability, which is classified as a current. The other 300,000, the remaining amount, is long-term. But after the end of the first year, when we prepare the financial statement at the end of the first year, this 100,000 becomes current portion of the long-term debt, because when we count the time gap between the payment, the end of the accounting period and the payment date, its maturity is lower than 1 year, so it is considered as short-term portion of long-term debt. The other 200 is considered as long-term liability. This holds through until the final 100,000 is paid for the creditors. Okay, short-term obligations expected to be refinanced, as we have discussed. If the company have a short-term obligation but expected or planned or budgeted to pay the liability by creating another long-term liability, it is not, even if the time gap between the two is lower than 1 year, it is not considered as a short term, because the company expected to refinance the liability or by creating another debt, another long-term liability. So Short-term liabilities, short-term obligations expected to be paid or refinanced or expected to be financed by creating another liability is considered as short term if and only if the other liability created to settle the first one is also short term. The other one, dividend payable. What do you mean by dividend? Dividends are distribution of cash for the shareholders of the company from the net profit of the firm. Usually, investors sacrifice their resource, their money for their money for the company in order to benefit or in order to get a return in the future. And investors always require a dividend or a distribution of profits from the company at the end of every year or based on the decision of the board of directors. So dividends, they are returns, incomes for the investors, but they are liabilities for the investee or for the company. At the end of the year, according to I-37, if the board of directors declared the dividend payments before the end of the accounting period, it should be included as a short-term liability of the company. But according to IS-10, even after the reporting period, if the company or if the board of directors declared the liability after the end of the reporting period but before the financial statements are authorized, audited and authorized for issue, they are not considered as a liability at the end of the year because there was no any liability. The past event is not yet satisfied at the end of the year at June 30 because at that time the board is not yet declared the liability, the dividend for the shareholders. Okay, the other liability, customer advance and deposits, as the name indicates, is arises when the individuals or when the customers pay cash in advance or deposit cash in advance for future services, products, or repayment of the cash. It may be their deposit, their advance may be used as a collateral for the product or service rented by the service provider for the customers. Unearned revenues, uh, at the name of the other liabilities indicate most of the liabilities are payables. Payable in a sense, they are settled by the payment of cash, but unearned revenues are liabilities arised when the company received cash in advance before the delivery of service and product for the customers. For instance, let's assume ABC company rented a building for XYZ company for the following 5 years, and the XYZ company paid the 5 years payment, which is birr 500,000 for ABC initially when the contract commences. And ABC company or the service provider, the rental service provider, collected the 500,000 from XYZ company, but it is not considered as a revenue for ABC because according to IFRS 15, any revenue is recorded after the service or product is delivered for the customers. At this time, even if the company received the 500,000, but the performance obligation is not yet satisfied by the ABC company, the service provider. So this 500,000 created a liability on the service provider, which is called unearned revenues. Earned revenues when the service or the product is delivered for the customer. Unearned, which means the service or the product is not yet provided, but the liabilities are raised because the cash is collected in advance. Okay, the other one is sales and value added tax payable, which is a liability expected to be paid for the tax authorities. It arises because of purchase and sale of products. Income tax payables, it is the one of the current liabilities of companies. It arises because of incomes. According to the Ethiopian tax rules, bodies are required to pay 30% of their net income for the tax authority after the end of the accounting period, but it is paid within 12 months of the accounting year, within 12 months of period after the end of the current accounting period. And there are other types of current liabilities related with employees of the company, like salary payables, bonus payables, etc. Okay, let us discuss about provisions, the main focus of this chapter, or the standard IS 37. By the way, the standard is IS 37 that specifically deals about provisions, contingent liability, and contingent assets. If the company is a large publicly accountable company, and if the company is small and medium enterprise, it is section 21st that deals about these issues. So we will try to cover those two standards, or two IFRS rules, in order to cover the small and medium enterprise and also publicly accountable entities, large companies accounting system related with provisions. What do you mean by provision? Provisions are liabilities. They are liabilities, but their unique feature is they are not certain liabilities. They are uncertain in terms of timing, amount, as well as occurrence, even if it is not clearly related in this slide. But IFRS states any liability is considered as a provision if there is a significant uncertainty on the timing. Timing in a sense, the time period or the specific date that the liability is settled for the other party, the amount of the liability, and the occurrence. Occurrence means there is also uncertainty on whether the liability is there or not. For instance, if the company sold products and provided a warranty for the customers, if the company agreed to repair and maintain the products, if there is a defect on the product sold for the customers. What if, let's assume the warranty period is 1 year, and the company agreed to settle any liability, to repair and maintain any defects from time A to B. But what if there is no any defect on the product sold for the customer within this time period? Is there any liability that is expected to be settled by the company? No, which means there is uncertainty on the occurrence. By the way, warranties are the best examples for provisions. But what if there is a defect on the product between this time period? Now the company expects to repair and maintain the product for the customer, so the company requires to pay cash to deliver, or exchange, or pay. The company expects to pay cash or provide service if the company itself had expected to modify or adjust or the product sold for the customers. Okay, so the unique feature is this. For instance, let's assume a liability that we have discussed in our previous slide, which is the salary payable, one of the employee related liabilities. Salary payable is a liability, but it is not a provision, which means all liabilities are not provisions, but all provisions are liabilities. Let's assume salary payable. Salary payable means the employee already provided the service for the company, but the company is not yet paid the liability for the the cash for the employee. The liabilities are raised. These liabilities considered as a current liability. It is not provision. Why? Because there is no any uncertainty on the occurrence. Because there is agreed contract between the two parties. There is no any uncertainty on the timing. Time is already clearly specified on the two parties contract. The amount, there is no any uncertainty. So salary payers, accrued liabilities like tax payables, they are, even if they are liabilities, they are not considered as a provision. Okay, provisions, common types of provisions, obligations related with litigation, court cases. Assume the company is sued by another firm because of using the company's patent rights, another company's patent right, and this case is already held, or the other company is already sued your company. So the company expects us to pay cash in the future, but the payment of the cash is not the amount of the cash that expected to be paid by the company is not yet known. Its timing is also uncertain because it is based on the judgment of the judge, and its occurrence is also uncertain. Okay, warranties, business restructurings, environmental damages, these are the best examples for provisions. Okay, why we discuss about those provisions?